Okay, we are going to look at a question on equity accounting. So with any equity accounting questions, the first thing you're going to look for is whether it is an equity method on investor book or equity method on consolidation, because it's going to affect the format of the journal entries. So you're going to scroll to the end of the question and then take a look at this one. You can see that this one is equity method on consolidation. So that's the first information that you need. Because if it is an equity method on consolidation, then we're going to prepare different kind of journal. But before that, the question requires you to prepare an acquisition analysis. So based on the beginning of the question, it says that the acquisition date was 1st of July 2010. In order to prepare the acquisition analysis, you need to know the amount of equity that the associate owned at the time of the acquisition. And that information is on this table, 2010. On top of that, you also need to look for whether there's any fair value adjustment. At the top of the question, you can see that there's only one fair value adjustment, which is inventory. And the amount was $10,000 below its fair value. And also at the end, you also see that they pay $425,000 for 25% of the interest. So that's all the information that you need in order to prepare the acquisition analysis. Okay, so let's prepare the acquisition analysis. So with the acquisition analysis, we need the fair value of net asset. So as we indicated, we have $1 million of capital, $600,000 of retained earning, and $50,000 of asset revaluation reserve. So that will be the amount of equity owned by the associate at the time of acquisition. After that, we also need to adjust for the fair value, and the only fair value adjustment was inventory of $10,000. So after tax, so we know that this is about inventory. So the amount of fair value in total was $1.657 million. So that's 100% of the equity owned by the associate. This is a question of equity accounting. You're not going to buy all of it. So the fair value acquired is 25% of that number. Which is equals to 414,250. So that's the amount of equity acquired by the investor. You're going to compare to the purchase price, purchase consideration. And based on the question, the investor paid for $425,000. So in this question, they paid more than the fair value. As a result, the amount of goodwill would be $10,750. And remember, in equity accounting, goodwill is not separately recognized. Okay, so you won't see goodwill in any of the journal. It is only part of the acquisition analysis. So that will be the first part. After that, let's go back to the question. Remember, we said that this is an equity method on consolidation. And under this format, there are a number of types of journal we need to prepare. So we can actually write down the type of journals we need to prepare here. We need a journal for retained profit. We also need a journal for profit. We also need a journal for reserve. And finally, we need journal for dividend. So those are the possibilities. So not every single question will have all these categories, but you got to actively look for that. So the first thing we will do is to look at the retained earning. So based on this question, we need to look for the changes in retained earning from the acquisition date to the beginning of the current year. So the question says that we're going to look for 2013. That means the beginning of the current year would be 2012. So the acquisition date was 1st of July 2010. So practically you're looking for the change from 600,000 to 700,000. That will be the starting point. So that increase in 180,000, that's the post-acquisition changes in retained earning. That's the starting point of us calculating retained earning. After that, we also need to look for adjustment. And there are two types of adjustment. The first one comes from fair value adjustment. The second one comes from inter-entity transaction. Let's take a look at this question. So as we said before, the only fair value adjustment was inventory, and it was $10,000. If you go back to the beginning of the question, you see that it says that the entire inventory was sold to the external parties within the following 12 months. What that means is that the associate sold the inventory 12 months after you bought them. As a result, that changes there is a prior year change, which is why we need to include that as part of the retained earning adjustment. Then we go further and to look for, do we have any inter-entity transaction? So the inter-entity transaction is on that paragraph, and it says that on 1st of July 2012, King Limited sold an item of plant to Queen Limited at a profit of $5,000. Take a look at the date. 1st of July 2012, that's the beginning of the current year. As a result, for this one, it's not going to affect retained earning. So we go back to the answer. So the first journal entry, we're going to write down retained earning. So we're going to look at retained earning. So first of all, we want to write down changes in retained earning. So that's the post-acquisition changes. And it was 780,000 minus 600,000. So for this one, we're going to start with 180,000. So that will be the starting point. That's the change from the beginning of acquisition up to the beginning of the current year. After that, we want to make adjustment. The only adjustment that we need is to take away the fair value adjustment of inventory. So that's a decrease, so we put it in bracket. Remember, everything has to be after tax. So $10,000 after tax is $7,000. That will be the only adjustment. So the adjusted retained earning would be 173,000. And remember, with equity accounting, we're only going to be account for the percentage of ownership. So for this one is at 25%. So the investor share of these changes in retained earning would be 43,250. So that's the amount that we need on the journal entry. So with equity accounting, we need to look for whether it's going to increase the value of the investment or decrease the value of the investment. For this one, it's an increase in retained earning. As a result, the journal entry will be debit investment in associate, 43,250. We are going to credit retained earning for the same amount. So that will be the first journal that we need to prepare. So going back to the question, we have 3 more categories of journal. So the second one we need to do is profit. So in terms of the profit, it's a bit easier because profit, you can just identify the profit. So based on the question, it says that for the current year, the amount of profit was $150,000. Okay, that will be the starting point. Once again, we got to look for adjustment. So do we have any fair value changes? And secondly, do we have any inter-entity transaction? As I said before, the only fair value changes came from inventory, which we already accounted for that in retained earning. So there's not going to be any further adjustment on the profit. So we can forget about that. So the only other thing would be inter-entity transaction. Take a look at that paragraph, you can see that King Limited sold a item of plant at a profit of $5,000. And remember we said that this one was current year. So for this one, we are going to adjust that as part of the profit. So this is an unrealized profit of $5,000. After tax of that, we need to take away from the profit. But remember, this one is also a depreciable asset. So on top of the unrealized profit, we also need to reverse the depreciation as well. So $5,000 is for the profit, and it says that it has 5 more years of life, and the company used strict line method of depreciation. So we got to gradually remove the depreciation on a yearly basis. So let's go back to the answer, and then write down the working on profit. With profit, the starting point was 150,000. 150,000. There's no changes from fair value, so the only thing is from inter-entity transaction. So we're going to take away sales of plant. It was $5,000 unrealized profit. After tax, there will be $3,500. Okay, so that one we need to take away from the profit, but we also need to adjust depreciation as well. With depreciation, we need to add back the depreciation because we are reversing, we are realizing the profit. So we're going to add back depreciation of plant. So 5,000 was the original profit, and then we need to divide it by 5 because we got 5 years of useful life. And remember that just like every other item, we need to get the after-tax amount. So as a result for this one, we need to add back $700. So that will be the adjustment that we need to make on the profit. So the adjusted profit would be $147,200. And once again, the investor will get 25%. As a result, we have an amount of $36,800. Okay, so that will be the information that we need for profit. So we're going to write down the journal after that. Again, this one is going to increase the value of investment. So we want to debit investment in associate. So for this one, it's going to be $36,800, and we are going to credit share of associate profit. Also $36,800. Okay, so that will be the second journal. So that's the two main journal, retained earning and also profit. And then we have two extra category of journals we need to recognize. So the first one is reserve, and then we also got the dividend as well. Obviously, in most of the question, you are going to see the amount of dividend. So with the dividend, based on this particular paragraph, you can see that for the current year, the associate declared $20,000 of dividend. So we're going to recognize $20,000 of dividend. With this one, once again, the amount of dividend recognized by the investor depends on their ownership, and they own 25% of that. So we're going to recognize 25% of that 20,000. And remember, this one is equity method on consolidation. So the journal entry that we need for dividend, we need to debit dividend revenue, and then credit investment in associates. So that's the format of dividend journal for equity method on consolidation. As I said before, the amount would be $20,000 multiplied by 25%. So the amount would be $5,000. So that's the journal on dividend. So the final journal is going to be reserve. So you're going to look for whether we have any reserve in this particular question. So the only reserve that we have is ARR, Asset Revaluation Reserve. And we're going to start from $50,000 and then increase to $70,000. Remember, the $50,000 came from pre-acquisition. That means the investor had already recognized that at the beginning. What we are looking for is the changes from the acquisition date to what we have right now. And the amount that we have is $70,000. So the change that we have is to increase $20,000. So once again, you own 25% of the associate, and you are going to account for that 25% increase in asset revaluation reserve. As a result, the journal that we need is to debit investment in associates and then credit ARR. The amount will be $20,000, 25% of that. So as a result, we have $5,000. So that will be the journal that we need. We got 4 journals, one on retained earning, one on profit, one on dividend, and finally one on asset revaluation reserve. So that will be part A. Let's go back to the question. We got part B here. With part B, we want to calculate the value of investment in Queen Limited in the books of King Limited as at 3rd of June 2013. So if you remember that the whole point about equity accounting is to use a single investment account to account for the changes in value over the years. That means if you look for the balance sheet and you look for the investment in associate, that is the updated value of that particular investment. So what we need to do is to start from the beginning when you invest in that company and then account for all the changes that we recognize in the journal. As a result, we can come up with the final answer, the current value of the investment. So what we need to do is we need to go back to the question. The starting point would be the amount that you pay, $425,000. That will be the starting point. And after that, in every single journal that you recognize, if you debit investment in associate, it means that you're going to increase the value of the investment. On the other hand, if you credit the investment in associate, it means that you want to decrease the value of the investment. So we're going to start from $425,000. Then we look for our journal. So for that one, with the retained earning, it's going to increase the amount of investment because we debit investment in associate. That will be the first one. After that, we got profit, which also increased the value of the investment. So that's the second one. And then we also got dividend. This time you can see that we credit investment in associates because when the associate declare or pay you any dividend, they will actually reduce the amount of equity, which is why this one we need to decrease the value of the investment. Finally, there's an increase in ARR. That one would be an increase in value of the investment. So there are 4 changes in total. We're going to account for all of them in order to calculate the current value of the investment. So now we're going to write down the changes there. So we're going to write down the initial investment. So that's the purchase price that you pay for on acquisition date. So that was $425,000. Okay, after that, we are going to add the retained earning. That is $43,250. Also, we're going to add the profit. That is $36,800. And then we are going to minus the dividend, which is $5,000, so that one is in bracket. And then finally, we're going to add the asset revaluation reserve changes, and that amount was also $5,000. As a result, the investment value right now would be $505,050. So that is the amount that you want to recognize on your balance sheet as the value of investment in associates. So that will be the answer of part B.